Hello fellow traders, I'm Marv Eisen of Timeless Dollar Trading Academy, and today in this video I want to talk about two things. I want to talk about targets and I want to talk about timing, and both are important concepts if you want to be able to trade successfully. You're looking at my chart of Thursday, August 10th, and here's a typical market, the way it trades, and I'm going to tell you right off the bat, the market hit its targets. Now, where were those targets? The targets were the close of the previous day, and you see that here with this horizontal line at 44.86. And that's an easy target to establish on your chart because you just go to the previous day and you make note of where the market closed, and then you take that price level and you just draw a line on your chart, and there you have a target for the following day. So that's one target. Another target, or targets that I use, is the Taylor trading support and resistance levels, with support at 44.72 and resistance up at 45.12. And these are calculated numbers using Taylor's trading technique. George Taylor's trading technique is the most valuable tool for me for being a successful trader in determining where the market is likely to trade. Along with these two trading levels, support and resistance, we also have a range. That is a range where the prices are likely to travel within a given day. Now, in addition to the Taylor trading zone to establish targets, the market also establishes its own targets throughout the day in support and resistance levels. And I think you know what I'm talking about. When prices reach a support and resistance level, reverse, and they go back up and back and consolidate within that support and resistance level. And many day traders and scalpers use support and resistance to time their trades, to time their entries and exits, and it's an effective strategy. And those are targets that the market puts in as the day progresses. So here on August 10th, there were three targets that I just told you about. There was the Taylor trading zone, support down at 44.72, resistance up at 45.13, and also the previous day's close at 44.86. So why did the market go up here? Why did the market go up here to 45.44? I mean, the market does crazy things, right? No, the market doesn't do crazy things. The market does things that are unexpected or unanticipated in terms of your thinking as a trader, but the market doesn't do crazy things. The market always has targets, and this was a target. And why was this a target? Well, because, and I'm going to take you back a few days, okay? I'm going to take you back 1 day, 2 days, 3 days, right over here. On Monday, August 7th, the market closed at 45.39 up here. It set out a target. Remember, the close of the market is always a target for the following day, or if it doesn't close, for days thereafter. And that's exactly what happened. From August 7th over to August 10th, where the market went up here, it closed the gap. It hit its target. So this was a target. So the market, from the time that it opened, didn't close the gap of the previous day, right? It went up to close the gap of several days prior. Then, having done that, went down, hit another target. And look, it basically consolidated for about 45 minutes at that target, at that 45.13 target, which is dictated by the Taylor trading calculations. Okay, then it did that, and after that, what did it do? It went down and hit the previous day's close. And here was the close on the previous day on August 9th, closed right down there, right over here, and it's exactly where the market went, okay? Gyrated around that a bit, but you see, then it went down and hit the Taylor trading support level at 44.72. But I'm trying to show you that the market has targets. It's not as crazy as it seems. So that's number one in this video. The market has targets and it reaches those targets. The problem is for traders, how do you trade the target? Because the market doesn't always go directly to that target. So let me give you an illustration from the following day. On Friday, August 11th, the market opened over here, okay? Market opened over here at 44.65. And the previous day's close, the gap was at 44.86. So about a 20-point gap trade, okay? So 20-point gap trade, a 20-point trade I think would be a very good trade in anyone's book, okay? So the market opened up right over there. And where did it go? It went up to the Taylor calculated support level at 44.72 and stopped. So for traders who got on immediately, figuring that they're going to take advantage of a 20-point gap, well, the gap didn't fill right away. So what happened when the market hit a target of the Taylor support level? Now remember, a target level, these are calculated levels, my friend. These are calculated areas. And when the market hit that, it backed off. And it backed off about, almost 10 points, okay? So for those who hopped on immediately, they could have found themselves flat or underwater if they held on. Seeing that the market was going to begin reversing or hesitating, and this is where I want to introduce the concept of timing. Timing is just as important than knowing the targets. If you got on immediately and figured that it was going to close the gap and saw that prices were hesitating, this is a 3-minute chart. Let me go to a 1-minute chart because you see it a little more clearly. Here's a 1-minute chart, okay? Prices, and I'm talking about this point right over here at 9:37. Prices rose from the open up to the calculated Taylor support level, which is a target. Doesn't mean it has to be support. In this case, it was resistance, right? And the market resisted it and went down to where it opened. And then ultimately came back, hit that resistance level again, Taylor's resistance level, went up briefly, hesitated, place to jump off if we're talking about timing here, came back down, hit the Taylor support level. Remember, support becomes resistance and vice versa, and then closed the gap. A 20-point trade, but if you got on immediately and you held on, or you got on shortly after, let's say 3-4 minutes after the market opened, you would have found yourself 7-8 points in the red. And if you got off the trade and that frightened you and you lost hundreds of dollars perhaps, you were probably too frightened to jump back on. Although you would have had to if you noticed that the prices didn't back off as much as they were, if they didn't test the low, could have stayed, withstood that 7-point reversal, and then stayed on again. The market opened here, tested it, didn't take it out. Over here, tested it again, didn't take it out, and then closed the target at the gap at 44.86. So these are the two concepts. And the aspect of timing, and what I'm really talking about is when you're trading, see how the market moves. The market moves in spurts. You see this candle over here? Big spurt, okay? 6 points or thereabouts. Let's see, there are 5 points between each horizontal line on this chart. So we've got easily 6, 7, a little more points in this one candle. But you see over here how these candles, when they go up and they hit a target, and you have to know where the target is, because you've got to say to yourself, why is it hesitating here? It's hesitating because it's at a target. And where is that target? It's at the Taylor calculated support level. So how do you know where the Taylor support level is? Well, you've got to be able to calculate the Taylor trading zone, the support and resistance for the day. And that's using the Taylor calculator. And I use this every day. I never trade without it. And most professional traders also put their faith in Taylor's trading zones, because the Taylor calculations, and there are about a dozen calculations that go into the Taylor trading zone. The Taylor trading zone is accurate for virtually every market. And that's why, for me, it's the closest thing to a crystal ball, because it gives me the insight of where the targets are for the day. And you notice I have a rectangle on my chart for every day that I trade, every day going back, rectangle, rectangle, rectangle. That's all you see, plus a horizontal line to indicate where the close of the previous day was. And if a gap, or if a market doesn't close a gap, I keep that line on my chart. There are other gaps on this chart that the market has not yet closed. There's one down below, I believe. I don't want to go into it. Now notice also on Friday, August 11th, the market didn't trade anywhere near the top of the Taylor trading zone. And why is that? Well, because Taylor, like everything else, is not 100%. But what did the market do? It actually put in a support at the Taylor support level and traded up to resistance at the previous day's close. And that's how the market traded. And you have to be able to recognize this. But if you're recognizing where the targets are, you have half the keys to the kingdom. The other half of the keys to the kingdom is watching how the market moves around these target levels. And the market does hit these target levels. It's how it hits them, it's how it moves to them that separates the good traders from the ones who lose money and get scared out of their positions. So that's my video for today. Marv Eisen of Timeless Dollar Trading Academy. If you want to get the Taylor calculator, you can get it from me at timelessdollar.com. It took me years to figure it out. And if you don't believe me, get Taylor's book and you see if you can understand what the book says, because it's virtually impossible to read the book and understand it. So that's my video for today. Thanks for bearing with me. Thanks so much for watching. If you would like to learn how to trade the way I can teach how to trade, check out my course at timelessdollar.com. But don't make the mistake of not using Taylor in your trading. It'll make a tremendous difference. So thanks again. Trade safely, and I'll see you in my next video. Marv Eisen from Timeless Dollar Trading Academy.